How's it going, everyone? It's Sam. Today we have something really interesting to watch. Over the last month, there's just been crazy swings in the market. I mean, look at Tesla, up 72%. A lot of people might say, hey, it was getting really undervalued. It was at $110. Had a forward priced earnings at that time of about the same as the S&P 500. But look at some of these other stocks, right? Amazon obviously sold off. It was at a good value, I think, up 24% in a month. Google up 21% a month. Facebook up 47%. Carvana up 218%. Lucid up 86%. Rivian up 20%. Bitcoin up 37%. A lot of other cryptos up 40% year to date. 180% or 140%. Polygon up 60%. There have been so many explosive moves, and a lot of people are thinking about going all in at this point. And there's an interesting point that we're at right now where we could continue racing, and I'll show you why. Now, we have a really interesting podcast to listen to a part of. The All In podcast, it's a great podcast if you haven't seen it already. One of the top podcasts on business in the world with 4 different VCs and tech giants, essentially. And Chamath talks about why the market's racing up right now. What's happening where big money is forced to buy in. And he talks about why they're buying in, what could change whether they continue to buy in.
I watched Powell's speech, and it was really amazing because in December, he was extremely hawkish. And he was basically like, listen, we're going to keep rates higher than you like and longer than you want. And that was pretty clear, and the markets reacted. And then not but 35, 40 days later, he essentially said we have 225 basis point hikes left to go. And he's going to try to stick the landing, essentially. And even though the rest of the language in his entire speech and the press conference, if you read it in the absence of his body language, so if you just read the transcript, would seem very hawkish as well. But the reality was he basically capitulated. And then the market essentially said, okay, we're at the end of this thing. And we've talked about this before, but markets tend to bottom 6 to 9 months before it's clear that you could have done this. And so we're a little bit off to the races in the short term. It's compounded by a couple of other factors. One is that at the end of last year, so many people were tax loss harvesting, which means if you had some gains somewhere else, you sold some things that were losing money so that you could net the two together. You saw a lot of stocks. Tesla was probably the poster child for this, trade all the way down to like $108 a share, and it's effectively doubled in the last 30 days, right? So everybody tax loss harvested, everybody degrossed, nobody was really owning anything. And then when Powell basically said we're mostly done, there's been so much systematic buying right now that nobody's really well positioned. To me, this is very similar and eerily reminiscent of the end of 2018 and beginning of 2019. And if you guys remember, at the end of 2018, October, November, December, the markets just fell. And part of it was Powell's going to raise rates, inflation's getting out of control, et cetera, et cetera. And then we got all this data that said China may be entering a real period of malaise, and Powell capitulated, again, trying to stick the landing. And long story short, he didn't. That was a head fake, and the markets just ripped higher. Then we went into the COVID pandemic and all of that stuff happened. So I think we're about to replay a little bit of that, at least in the next 30 to 90 days. The pain trade is to go up. So that's probably where we're going. I think Sachs is right. I think the marginal risk here is for this whipsawing. So we have a period now which is disinflationary. But the problem is if the stock market keeps going up and all of a sudden we have less restrictive monetary conditions, then we're going to be back at the same place we were before, which is money sloshing around into all kinds of risky assets or more money. You know, there's still an enormous amount of money sitting on the sidelines that has to come into the market now if this thing keeps going higher. So we're in a delicate moment. And if we reignite inflation because all of a sudden more companies have more liquidity that they can tap, right? More money they can raise, more money as a result that they can spend. Because we don't have this first inflationary cycle under control, there could be a risk that we reignite inflation. And so then they have to capitulate, the Fed has to capitulate again and start another hiking cycle. So I think it's a complicated moment. I think all of the smart money in Wall Street that I talked to up until this point, they forecasted like this period would be choppy and the second half of the year would be really robust and like you needed to be super long and things were going to be incredible. And when I talked to them this week, they're like, oh God, we weren't positioned for this. We had no risk going into this. We're going to be forced buyers. There's a bunch of companies that are whispering that they want to go public now.
Oh,
And
really?
so the big banks have been calling around trying to book build quietly for some IPOs. And so if they try to kind of crack this capital markets open, I think there's, again, the marginal risk will be that we do whipsaw, as Zach says.
When you
And
say
we go-
book build, you mean trying to see if you'll get some early takers to buy equity in an IPO, perhaps even in a company like Stripe that's been sitting on the sideline?
So not Stripe, they're in a complicated moment, but when they call to book build, they basically say, hey, listen, XYZ company, quiet filed, look at the S1, what do you think, where's the price, blah, blah, blah. And they're trying to get an indication of whether you'd want to be in the IPO book. So I think that there's a lot of those testing the waters that are now starting again.
Would there be an appetite in your mind for an IPO in the second quarter of like a Stripe type company? Putting, I don't know what the other candidates are, the lead candidates, but Stripe is the one people talk about most.
The thing that we have to think about is like most of the market are not people, right? Most of the market are computers and algorithms and ETFs. It's an extremely formulaic buying model. You have components of an index, those represent certain percentages. You have to own those percentages to be relevant as that index. And so it's this reinforced buying loop as well as a reinforced selling loop, right? So when things start moving, those folks have to just systematically move money in. All the humans know that. So the humans tend to front run all the computers, and they basically are the ones that sell into these guys. And then that's what inflates these prices. Similarly, on the way down, humans try to front run it by being short into that stuff. So we could see the capital markets open. Even if we don't, it's actually the worst scenario because now you have all this money going into a fewer number of names. That sort of explains Facebook has doubled in 30, 60 days.
Yeah, I was about to get to that. Yeah.
Tesla has doubled in 30, 60 days. A lot of the tech stocks, like high beta stocks that we are all, helping to build, those companies have just absolutely ripped 60 to 100%. These are not healthy and normal moves. And so the question is what happens if inflation somehow all of a sudden pokes itself back up? Right now, it doesn't look like it is. And Powell was clear, and it's true. We're in a deflationary
Well, he said
cycle.
Deflation 11 times during his, he's
we're in a
very
deflationary
clear about
cycle.
his use of language. Yeah.
That's why the market rips.
Now, I watch the All In podcast every single week, but I think this was really insightful for why the market's moving up and why it's moved so much throughout the entire year so far, the last month. Big investors did not have enough risk assets. They thought that inflation was going to take longer or the Fed was going to take longer to become dovish. While retail investors, I think a lot of us have been thinking that the Fed was going to turn pretty quickly. So maybe this is one of the times that we're one up on Wall Street. We're not trying to hedge our bets so much in the next few months. We're more worried about the long term, which is something I think we can do great. One thing that can make us do great over the long term is the fact that we aren't worried about the next 6 months or the next year. We're buying assets that are going to do well over the coming 3 or 5 or 10 years, 50 years. And we're willing to dollar cost average. We're willing to buy when things are low, even if they could get worse, because we're more worried about building wealth long term. Now, at this point, it's really a question of whether inflation continues to come down, because there is a lot of excitement in the market. There's a lot of excitement, and people might start hiring a little bit heavier again if we don't think we're going into recession, or we think that this soft landing really can't be achieved, or the Fed's going to stop raising rates. That could lead to the market or the overall economy overheating a bit and then causing inflation to tick back up. And that's really the worst case scenario. At this point, though, a lot of investors still are not long. They don't have enough into the market. So we could continue to see prices go up. And I think whenever we get good news come in, if we get CPI next month and it comes in quite positive, and that is coming up very soon, the next CPI report, just about a week and a few days, I believe. If that comes in pretty low, that could be really good for the market, and that could be like one of the next nails in the coffin, which causes a lot of big money to flow into the market, and that could be our next leg up. Now, I posted a video earlier today on what's happening in the market, so go check that video out on the end screen, and I'll see you in the next one. Bye.